section in Chapter 4. We've previously done 4.1 through 4.3. If you haven't had a chance to work on those application problems, hopefully you can work on them. Get a calendar out or a little schedule out and kind of budget some time for it. I know it's not that they're excessively hard. They're just advanced accounting problems. They're kind of big. So if you can put some time down on paper where I'm going to work on this for an hour today or something. I know it's not ideal, but if you can do it, that'd be awesome. All right. So here's 4.4. We're going to do some closing entries, prepare a post-closing trial balance, and kind of summarize the cycle. This is our last chapter in our unit. Then we will move on to an reinforcement activity. All right, so we're going to journalize closing entries. We're going to post-closing trial balance. We're going to summarize the accounting cycle. First, these are the 4 closing entries. We're going to have a closing entry for income statement accounts with credit balances. We're going revenue and contra accounts. So we're going to go into the income statement credit column, income statement accounts with credit balances, in the adjusted trial balance. In the adjusted trial balance, we will then close the second closing entry, income statement accounts with debit balances, cost, contra revenue, and expenses. So revenue would be all the sales, contra cost accounts in the first one, and the second one will be cost, contra revenue accounts, and expense accounts. So if it has a credit balance to close it, we would then have to debit it. If in the second one, these have debit balances, in order to close it, we would do the opposite. So we would credit all these. Both of these will be dumped into what's called income summary general. The third entry then is a closing entry to record net income or net loss and the retained earnings amount, which then closes income summary general amount. Okay, and then the last one is to put dividends. Close dividends, that's a temporary account. We close dividends into retained earnings. Okay. All temporary accounts, again, as a reminder, journal entries are used to prepare temporary accounts for new fiscal period. Basically, permanent accounts are the balance sheet accounts. We want to keep them moving on and having the balance of cash into the next fiscal period, or how much insurance we have in the next fiscal period. The temporary accounts are the income statement accounts for the most part, sales and these things. We want to keep track of fiscally year to year, month to month, whatever the time period might be. And so we get rid of all of our expenses, revenues, contra cost accounts, contra revenue accounts, dividends, so that we can have them start each fiscal period with 0. So the temporary accounts are closed. The accounts are closed into an account called income summary. This account is used to collect all the balance of temporary accounts. We'll show you what that means. Only temporary amounts are closed. Permanent accounts are needed to continue. We just kind of talked about it. So step 1, it said we want to closing entry for income statement accounts with a credit balance. So you go to the unadjusted trial balance, find all the income statement credit balances, accounts that have credit balances, and we would debit them. So we're going to debit income summary grills through sales, purchases. These are the contra cost accounts. And you add all those up and you dump it, or credit, I always say dump it into their income summary general. So these are in your unadjusted trial balance in the credit balance, okay, for the income statement accounts. Then the second account is closing entry for income statement accounts with debit balances. So you go to the unadjusted trial balances, all of these accounts, income summary furniture through sales, discounts, these are the revenue contra accounts, these are all the cost accounts and expenses. These all have debited balances. To close them to 0, we need to credit them, add them all up, and then debit income summary general. Okay. The third transaction then, closing entry, record net income or net loss and retained earnings, and to close income summary general. So we have an income summary general credit of $987,388.04. We have an income summary debit of $922,161. So what I show you here is this is the closing an income statement debit column, we put it in the credit. Okay, closing the income statement credit column, put it in the debit. Okay, the leftover net income we need to get rid of. All right, so the balance is 0. So how do we go about doing that? It shows you here. The credit statement is this number. The debit statement is this number. We subtract to get, and this is our net income that you already know because you did it in the income summary or the income statement, financial statement. So in order to credit, this is the balance income summary. So we're getting rid of it. So we are going to then, since it's a credit balance, the bigger part, 987 is credit. That's bigger than 922. So this is net income. We have to close that by debiting the total amount of net income into income summary general. That wipes income summary general back to 0. Okay, it gets income summary general back to 0. And then we put the retained earnings, we increase retained earnings by net income, which is what we want to do anyway. So that is what they mean by the third entry, closing entry to record net income, which is that 65,000 number, into retained earnings, and to close the income summary account. We get 2 birds and 1 stone on this one. Now again, if it was a loss, you would flip-flop it because income summary debit would be bigger than credit, and we would flip-flop it. But for our purposes right now, we're just doing with net income. The last income statement, or closing account, excuse me, is closing entry for dividends. Okay, dividends we pay out to our shareholders. And that's all decided, by the board of directors. So we have retained earnings and dividends as our entry, the last entry. We debit dividends normally, so to get rid of it, we have to credit it. To increase retained earnings, we usually credit it, but dividends decrease it, so we debit retained earnings, credit dividends for the last closing entry. And it tells you that since dividends decrease the earnings of corporation, dividends amounts close to retained earnings. Okay, we get this information from the adjusted trial balance. After closing all these, temporary accounts are back to 0, and we're ready for a new fiscal period. Okay, the examples are there for you. Post-closing trial balance is just taking, after you do all those closing entries, you'll have to post them, update them, get them to 0. And the post-closing trial balance is just a list of all the accounts that will be moving forward with balances to the next fiscal period. Reminder, debits always should equal credits in the general ledger, and a trial balance is prepared for the post-closing entries after they're posted. It's called the post-closing trial balance. So what it is a who, what, when, Wiley Outdoor post-closing trial balance, December 31st. It's a list of all our permanent accounts that we did not close, that have balances that we are taking to the next fiscal period. So you basically are just getting these out of the adjusted trial balance after you post the closing entries. So you can see it's the balance sheet accounts, assets here, along with the depreciations, payables, okay, and dividends, after dividends payable, you see capital stock and retained earnings. These are the amounts that will be moving towards the next fiscal period. Everything else should have 0. And then lastly, the summary of accounting cycle just goes through source documents, making sure they make sense, reviewing these, journalizing these, posting these, getting an adjusted trial balance, making adjusted entries, heading them over into posting them into the ledger, making an unadjusted trial balance, making financial statements that are all listed here, going ahead to closing entries, posting those, and getting a post-closing trial balance. In between there, we get the accounts payable and receivable subsidiary ledgers set up. A list of these is down here. Basically, this chapter is almost basically half of it, or over half of it. It's like 5 through 12. The series of accounting activities included to record financial information for a fiscal period is called the accounting cycle. That's what this is. It's a little more involved than it was last year, but that's good. That's what we're aiming to do. That should be it for 4.4.